Good morning, ladies and gentlemen, and welcome to today's IGE Webinar. A warm welcome as well to Dr. Robert 슈바라만. It's a great pleasure to have you with us live from Singapore. Thank you, Rob, for joining us once again. We are truly delighted to host Dr. 슈바라만, one of the most respected voices on the Asian economy and global financial markets. His insights are especially timely as we confront mounting uncertainties in the global economic environment. Today's session will focus in particular on the policy and strategic implications of escalating tariff tensions and external shocks, key concerns for many Asian economies, including Korea, which recently reported an unexpected contraction in GDP for the first quarter of this year. These developments come just days ahead of a pivotal presidential election, further intensifying the policy and market outlook. Dr. 슈바라만 currently serves as a chief economist and head of global market research for Asia, excluding Japan, at Nomura, one of the world's leading investment institutions. He also chairs the Asia Research Executive Committee and serves on Nomura's Global Market Research and Global Emerging Markets Executive Committees. Before joining Nomura in 2008, he spent over a decade at Lehman Brothers, where he was chief economist for Asia. And earlier in his career, he held senior positions at the Reserve Bank of Australia. Now, without further ado, please join me in welcoming Dr. Rob Subbaraman, who will begin with about 45 minutes keynote presentation. Now, today we would like to give him ample time to share with us his insight on the latest development in global economy and financial markets, based on his report with the many useful, elaborate charts and tables. Total of more than 50 pages. So I think he needs more than 45 minutes to go through those. And then we'll have a relatively brief Q&A session to finish at 10 a.m. In Korea Standard Time. Rob,
okay,
welcome again. Floor is yours. Thank you very much for joining us again.
Thanks very much, Dr. Jun. Can you hear me all right? Just check
yes,
before
just
I
fine.
get going. Okay, great. Well, look, thank you very much for the kind introduction, and it's my pleasure to be back speaking in front of this seminar hosted by IGE, who have over the years done some fantastic seminars. I was lucky enough to attend in person a very big one you did in Seoul a few years ago, and I thoroughly enjoyed myself with that packed room. So as you said, I plan to talk about, I think there's certainly, I got told the other day that I'm a rock star now because macro economists are so much in demand. And I don't know about the rock star, but it is true that it's very much a macro driven markets now. You know, there's times when it's more micro driven and stock picking, but I think right now there's some very big themes in Korea and also globally. So I plan to talk about starting with the global outlook and particularly the US outlook, and then we'll start to focus more on Korea towards the end, and also the financial markets a little bit. So without further ado, let me get going. And just to check, Julia, can you see my screen all right? Is it showing up?
Yes.
Okay, perfect. Okay, so the first slide, just to give you a feel for Nomura's economic forecasts. I'm not going to go through all the numbers, but I would highlight that we are forecasting a growth slowdown. Importantly for the US, you can see that after slightly negative growth in the first quarter, we have a bit of a recovery. But I would say it's very, very low growth, below trend growth for the US and close to recession, just avoiding recession. And most other major economies also has a slowdown in growth this year, including China as well. I'd say in Europe it's not recession, but also like the US, quite low growth. Inflation is different, and I think this is important to realize that the tariff war that's going on with the US imposing tariffs on most other countries around the world, we think is going to be a stagflationary shock for the US. It's going to lead to higher inflation, but slower growth. But outside the US, it's more like a negative demand shock, because most other countries have not raised tariffs yet on the US, and we don't think they will raise tariffs much. And so it's more of a weakness in exports and investment through all the uncertainty. And so you get weaker growth and weaker inflation outside the US, whereas in the US, you have weaker growth, but higher inflation. And that brings me to the policy rates, where you can see because of inflation going up, but growth slowing, but not dramatically in the US, we think the Fed is going to be quite cautious and not rushing to cut rates further. We don't have the next rate cut in the US until December this year, which is later than the market currently thinks. In contrast, because of the negative demand shock and growth and inflation slowing, we do have most other central banks cutting rates before the Fed. And that brings me to the central bank outlook. You can see pretty much as I just mentioned, the first column, you can see that from May, where we are now, we don't have any cuts by the Fed at the coming next 4 meetings, with the next cut not till December. But as I said, other central banks, quite uniquely, we think will be cutting rates more than the Fed. And you can see, I'm sure many of our viewers are focusing on Korea. You can see we have the Bank of Korea cutting later this month, and then 2 more times. And I'll talk more about that later. Just a word on tariffs, and I'm going to focus a bit more on the US now. You can see from this slide kind of 3 scenarios around the US tariff rate for this year. As I'm sure you all know, the US under Donald Trump raised tariffs very aggressively, and there was a tit-for-tat tariff war with China, with tariffs going up to over 100%. At the peak, the US effective tariff rate was around 20% on Liberation Day, and just after that. Since the de-escalation, our baseline is that the effective tariff rate is going to kind of settle now at around 15% for the US. We do think that it's going to be, as you can see, a reciprocal tariff rate of around 30% on China, plus for other countries, we have a 10% kind of universal tariff rate. So some reductions because of the trade deals that we think will happen, but there'll be sectoral tariffs as well. And we think that will be fairly broad-based on various sectors that the US has announced of around 25%. So that gives you the 15% effective tariff rate. And if you look at the bottom right chart, I think it's important to notice, even with this reduction, a 15% tariff rate is still very high. The effective tariff rate last year for the US was around 2.5%. So this is many times higher than that. And if you look at this chart and convert it into how much how much tariff revenues out of total revenues the government's going to get, well, in between these two dashed lines is the 15%. And you can see that would be somewhere around high single digit total tariff share out of total government revenues, the share from tariffs, high single digit, much higher than, you've got to go back to the essentially the 1930s to get a similar kind of amount of revenue raised from tariffs. So point is, it's still going to be, even though there's been some de-escalation, tariffs are very high, and that's a tax on US importers. We think it is going to lead to higher inflation. We think firms will pass on some of that cost to consumers, and we are forecasting by the end of the year, the US core PCE inflation rate at around 3.3%, well above the Fed's target of 2%. And you can see we have growth slowing to 0.8% quarter and quarter. And you can see we have a more aggressive forecast there if tariffs go up again further, and that would lead to a recession. And then a more benign outcome. But even in the benign outcome of a tariff rate of around 6%, you can see inflation is still pretty high, 2.8, and growth still below trend at 1.1. I think a key point to make is uncertainty has already risen very substantially in the US, and that also is going to be weighing on growth, even if tariffs come down further. And on that, I just wanted to reaffirm that it's not just us that are thinking about stagflationary concerns in the US. The FOMC members, the 19 FOMC members, back in March, just before the April 2 tariffs were announced, they had already lowered their growth forecast for the US for the fourth quarter year on year to 1.7%. And they had raised the inflation forecast to 2.8%. But what is most striking, and a lot of people don't realize, is they also put the risks around these forecasts, the 19 FOMC members. And you can see in the right-hand chart that out of the 19 FOMC members, even though they cut their growth forecast to 1.7%, 18 out of the 19 still saw downside risks to their new lower growth forecast. And the opposite for inflation. They raised their inflation forecast, but they saw 18 out of the 19 saw upside risks to their 2.8% inflation forecast for this year. That's very similar to us. And as I said, soon after these forecasts were unveiled at the March FOMC, the tariffs went up further. So we do very much think the Fed is concerned about the stagflationary effects. And we do feel that having made the mistake during the pandemic of thinking inflation was transitory, that this time round, they're going to be a lot more cautious. Even if growth slows a bit, they're not going to cut rates unless they're sure that inflation and inflation expectations are not picking up. And you can see in this chart why they're probably concerned, because a lot of the pipeline indicators of inflation are starting to rise. You can see that in the manufacturing and services PMIs, the price indexes are going up, especially manufacturing, but also inflation expectations. The market-based measures are still quite low, but some of the surveys of households and businesses show inflation expectations starting to rise. I mentioned about uncertainty, and on the left-hand chart, you can see a measure of US economic policy uncertainty. Interestingly, it's risen to similar levels at the peak of the pandemic. And that was very, negative for the economy until the stimulus arrived. And you can see on the right-hand chart that business surveys are suggesting that firms are starting to delay their planned investment spending, the red line. And so we do feel that the hard data, the real capital goods orders, is probably going to weaken as well. Okay. I talked about how the US economy, we think, is going to start facing, as soon as we get the data for this month in May, which will happen in early June, we think it will show signs of inflation picking up and growth slowing down. I said the Fed is not going to react, it's not going to be proactive in responding to the growth slowdown because of the inflation. What could change that is if the growth slowdown turns out to be very sharp. It's not our forecast, but it's certainly a risk that the US goes into recession. One way that could happen is if firms decide that consumer spending is not that strong and they want to maintain market share, and so they absorb most of the tariff costs into their profit margins. As Trump says, that they eat the tariffs. That would be bad for profits, and that would be very bad for the investment outlook. It could be bad for the equity market. And you could see in an environment like that where maybe inflation doesn't go up that much, but we see a bigger hit to growth, that could cause the Fed to have to come to cut rates earlier. Another way this could happen is we're seeing just this week, US long-term interest rates, the 10-year bond yield, the 30-year bond yield, rising quite sharply. I think the 10-year bond yield is now around 4.6% because of fiscal deficit concerns. That also is a cost of capital, the long-term interest rate, and that could also slow the economy. So what I wanted to show you here is what's known as the SARM rule. This is a very good leading indicator of signaling recession. And you can see I've written at the top here, it's basically a simple formula. It's when the 3-month moving average unemployment rate rises by 0.5 percentage points or more above its lowest point in the past 12 months. And so I think this SARM rule is going to be very important. And I show on the right-hand side some simulations. The unemployment rate currently in the US is 4.2. But if you start to see it in the coming months go up, I would say if by July, August, you're getting towards 4.8%, that is where the SARM rule is going to breach its threshold of 0.5. And that would be a strong indicator of recession. Just to show you how successful this SARM rule is, this is showing you when it's breached the 0.5 threshold, and the gray shaded bars when on the left-hand side is when payrolls, non-farm payrolls turn negative, and the right-hand side is the National Bureau of Economic Research's recession indicator. And it's been very successful, this SARM rule of predicting when the US goes into recession. The one real exception was actually last year, where it slightly breached the 0.5 threshold, but there was no recession. And I would signal, something very strange happened last year. It was because after the pandemic, there was massive immigration back into the US under Biden. And that increased the US labor supply a lot, with a lot of migrant workers looking for jobs. And so the unemployment rate in the US went up, not because companies were firing workers, but because there were a lot of new people looking for jobs. And that caused, they had entered the labor force. They were immigrants. What's happened now is it's going the opposite way. The supply of labor is going down again. Trump has cracked down very hard on immigration. And I think any rise in the unemployment rate significantly from here is probably going to be more to do with workers being laid off, being fired, rather than a big increase in new people looking for jobs. So I would watch that SARM rule. I think it's back. And that's one thing that could change our call of the Fed cutting not until December is if we see the SARM rule being breached because of a sharp rise in unemployment. Okay, I've got 2 more slides on the US. I did want to say that there's a lot of discussion when I speak to clients around the world. I was in Europe and the US recently, but in Asia as well, about is the US losing its economic exceptionalism? Are we starting to see investors who have invested so much in the US, and you can see that on the left-hand chart. The red line is US financial liabilities. So it's how much, it's really how much overseas equity investments, investments into US bond market, foreign direct investment, it's all of it together. And you can see that since the global financial crisis in 2008, that red line has gone up very sharply and much more faster than the gray line, which is how much the US has invested overseas. And so the US has become a very large net debtor nation. So the world had invested very heavily in the US, and now there's concerns with the US growth slowing. I talked about the stagflationary risks in the US, growth slowing, inflation rising. Is the US economic exceptionalism fading? I would say the US economy is going from an exceptional economy right now to a more normal economy. And I think that does mean that investors who had gone overweight the US are moving back to a more neutral position on the US. So I think it does make sense that you've seen this triple decline recently in the US equity market, bond market, and dollar. Then the equity market rallied back again. But I think we could certainly see another episode of this triple decline, and we have been seeing it, for instance, this week and overnight. You can see from this chart that US growth, the gap, US in 2024 was growing much stronger than other big economies. But if you look at our forecasts for 2025 and 2026, that gap really narrows, particularly with Europe. They're about on par for 2026. Also for bond yields, the US 10-year Treasury yield used to be a lot higher than Germany, UK, Japan, but that gap is starting to narrow as well. So there's other markets where investors can earn fairly decent returns. So that's the benign outlook for US economic exceptionalism, that it is fading, but the US is going from exceptional to back to more normal. But what's the risk that it's more structural than that, and the US actually goes below normal, and foreign investors demand a higher risk premium for investing in the US? It's not our base case, but I would say that it is a bigger risk than it's been for many decades, that the US could be downgraded in terms of a safe asset by foreign investors. And certainly Moody's did that just recently. I've put down here the Triffin dilemma that the US faces, because it's the sole global reserve currency, and so it's obligated as having the global reserve currency to satisfy the insatiable demand for safe dollar assets by the rest of the world. But as it provides, as it's the provider of these safe assets with so much money coming into the US, it can drive interest rates low. It can lead to too much liquidity in the economy. It can drive asset bubbles. And, with very strong capital inflows and low interest rates, it's a license for the government to be able to borrow easily. And you've seen, as a response to very strong capital inflows, large US trade deficit and budget deficit. And I show here, because of so many years of running big budget deficits, that the total gross financing needs of the US these years is around 15% of GDP. Now, if foreign investors start to question the safe haven status of the dollar, if they start to worry about the fiscal situation, Fed independence, rule of law, the global security reach, various factors, and they start to demand a higher risk premium, we could be entering a period where you have a more structural decline in the US dollar and higher long-term interest rates in the US. Right now, I would say we're in between these two things, where certainly the US does not look like an exceptional economy anymore. I think that's fading, but we're not sure whether it's actually going to be moving towards a less of a safe haven. And, one of the strongest arguments against a structural decline in the US is because there's really no clear alternative to the US dollar at this stage. Just a quick word on some of the other big economies. I'd say in Europe, Trump has done Europe a favor. I've called it here, Make Europe Great Again, MEGA, because he, by suggesting that Europe needs to stop free riding on the US, it is pressuring the European Union to unite more closely together. And we are optimistic that there's going to be much larger fiscal expansion, particularly in the biggest economy, Germany. There'll probably be joint issuance of defense bonds. And we're hopeful that Trump's pressure on Europe is going to bring the European Union closer together, which will be a positive thing. But this will take time, and we think this is more a 2026 story. 2025 is going to still be quite a slowdown in Europe, and the US tariffs are going to be adding to that slowdown. Japan, we do feel that Japan is heading towards a more normal economy. It is starting the 3 hikes again, which hasn't happened for decades, and that is inflation is rising, prices are going up, wages are going up, and interest rates have been going up, albeit slowly. I would say, one key thing in Japan, and you in the audience are familiar with this for Korea, is the demographics. You can see the working age population, the gray line, has been steadily coming down, and the number of working people in Japan has been going up. But that red line, by definition, cannot go above the gray line. So Japan is genuinely running out of workers. And no surprise, we are starting to see a notable pickup in wage growth. And this is quite positive news for Japan, that you are seeing wage growth pick up. That said, I would say that the inflation outlook in Japan is more nuanced. You can see in this chart that the kind of core CPI measure in Japan, core CPI is different to core CPI in Korea or America. They only exclude fresh food, and it's a narrow underlying measure, and that is above 2%. But if you measure it, if you look at core CPI, which is more similar to Korea's underlying inflation measure or America's underlying inflation measure, the red bars, that's still running at around 1.5%. It hasn't got to the BOJ's 2% target just yet. And we're arguing that while there's encouraging developments happening in Japan, the complete virtuous cycle between wages and prices is not yet complete. And in particular, consumer spending has not picked up strongly enough yet to feed back into prices. So we need to see wages are going up, but we aren't seeing overall consumption picking up strongly yet. And that's partly because the labor force is shrinking. There's less workers. We need to see consumption pick up strongly, and then that demand-driven inflation will start to pick up. That hasn't happened yet. And also, while wages are picking up, they aren't picking up as fast as inflation is still faster than wages at this point. So we want to see real wages picking up. I'd also point out that the Bank of Japan is becoming more cautious on the inflation outlook. At the last meeting, they revised down their inflation forecast for this year and next year. And like the FOMC, I showed you a chart earlier, when you look at the risks around their forecasts, most BOJ members see downside risks, which is the red diamonds, to their lower inflation forecasts. So adding it all up, our view is that the Bank of Japan is going to be slow in raising rates, slower than the market thinks. We think the next rate hike by the BOJ will not happen until January 2026. And then we think the BOJ will be done. That will take the policy rate to 0.75%. And we think they will most likely stop there. So Japan, I would say the demographics are still a very powerful force that makes it difficult for the economy to grow significantly, above like 1% growth. So we have still a fairly low terminal rate of 0.75%. I would say, though, that Japan is changing in interesting ways. I talked about how inflation expectations are back. They've moved away from the deflationary mindset. And so that is feeding into wages. And I think it's now, in the old Japan, it was a very low growth equilibrium where firms never wanted to raise their prices because they were afraid they would lose market share. And so with no increases in prices, they never increased wages. And so workers had no incentive to work harder because they weren't going to get a pay increase. That's all changing now with inflation expectations back happening. Firms are willing to focus more on maximizing their profits, and so they will raise prices, and they are passing it on to workers in higher wage increases. And so workers are encouraged to look for better jobs where wages go up more. So it's creating more dynamism in the economy. And that is really important, in our view, for boosting productivity. The other thing that's happening with inflation is there's less incentive for households to keep their money in bank deposits, earning very little interest, because when there's inflation, their real return is negative. So they're investing more in the equity market, including overseas equity markets. And so savings is being put to better work rather than just going into banks and then into the government bond market, which is invested in, low return infrastructure projects. So I think savings is going more to the private sector, and this is more dynamic for the economy. So overall, we are positive on Japan from a kind of medium-term perspective because inflation and wage growth is back. China, I don't want to spend too much time. I would just say that this is probably the key chart on China. China, during the pandemic, had a property market crisis, as you can see in this chart, but it was saved by exports being very strong. The challenge for China now is that the property market remains still very weak. But we think exports are also going to slow down in the second half of this year. So there'll be this double whammy. There's more policy stimulus coming, but it's facing this double whammy that means growth is not going to pick up that much. And I think this chart is very interesting for China. You can see consumer confidence is very low. And also households have accumulated a lot of savings in bank deposits. So households are very cautious. So, interest rate cuts are not having that much effect because households don't want to borrow at the moment. They're deleveraging. So policy is not that effective. And we think that ultimately China's economy may be a bit stronger this quarter. We think around 4.8% growth, which is pretty good growth, but that is partly because of export front loading and partly because of a trade-in program for consumer durables, which the government is subsidizing. And so people are bringing forward their consumption of durable goods. It means in the second half of the year, there'll be payback on exports and also on consumption. And we're forecasting 4% growth. Now, finally, just on Korea. So as Dr. Jun mentioned, Korea's economy contracted in the first quarter. And if you look at the breakdown of Korea's growth in the first quarter, the slowdown, particularly quarter on quarter, was fairly broad-based. In fact, it was only research and development investment that had a positive growth rate quarter on quarter. Now, Korea, I would say, it has been facing a challenging time in that in Q1, domestic politics was very uncertain. The global geopolitics was very uncertain. And then you had these two structural headwinds. One is demographics, and the new one, I would say, is growing competition from cheap Chinese imports. The good news for Korea, I would say, on the export front is chip exports have been strong, and we think they're starting to pick up again into Q2. That's partly the very strong AI demand, particularly for the very high-end chips. But also what's happened is that with China's trade-in program for durable goods that I talked about, there's been a lot of rush in demand for new durable goods by Chinese households. And a lot of these are electronic consumer durables that require lower-end chips. And so China inventory of lower-end chips has gone down, and that's a good opening for Korea. And we think that is also helping chip exports into Q2. But outside the chip exports, the red line you can see is quite weak. And that we think is probably going to remain fairly soft. And certainly the tariff escalation that's happened this year is not helping in that regard. Consumption in Korea also we think is fairly soft. And you know, part of this is the high household debt burden. But also I think it's the demographics. You have a labor market where employment growth is concentrated among older workers and their wage increases are not as large. Youth unemployment is fairly high. You know, ironically in Korea, when interest rates come down, if you look at household balance sheets, because of the demographics, they rely a lot on interest income. And so that is being affected for the household sector when interest rates come down, less interest income. I would say that, you know, more broadly for Korea, I think there is the challenge I see is it's a bifurcated economy where you can really see it in the labor market where there's regular workers, but there's a very large share of non-regular workers that don't get the same wage levels, that don't get the same social security benefits, non-wage benefits that regular workers get. And, you know, I think it's also linked to the education and housing. You know, getting the very high quality education, you need to be located in certain areas where housing costs are very high. And if you get all that, you get into the big chaebol companies and become a regular worker. Otherwise, you're kind of left out. And I think this bifurcation, this unevenness in the economy is weighing on consumption. I was reading a report by the IMF that if you were a regular worker, the probability that you would be having a family and a child was twice as likely than a non-regular worker. I'm sure you're all familiar also with the construction downturn that's happened. That we think will remain a drag on growth around for the rest of this year as well. So with this fairly soft growth outlook, we're forecasting 1% growth for Korea this year. We do think inflation is fairly under control right now. and that is opening up the room for the Bank of Korea to cut rates, which I'll get to in a second. I did want to say a word on the fiscal. So there's the election outcome that's coming very soon. The polls are suggesting that the opposition party president will get in. And we do think that is going to mean more fiscal expansion. In addition to the first extra budget of around 14 trillion won, we think there'll be another extra budget of somewhere between 20-25 trillion won. That's much larger, around 1% of GDP. So that's good news. There will be more fiscal expansion. The bad news is around the tariffs. We do think that they are going to be significant against Korea. I know that trade negotiations are going on. We do think that there may be some relief around auto parts tariffs, the 25% on that. But we think the tariffs on motor vehicles, auto vehicles, is going to remain. And you can see here, our base case scenario is that the overall effective tariff rate is going to be close to 20%, the US tariff rate on Korea. And that's led to our new growth forecast of 1%. In a way, the fiscal stimulus comes at a welcome time, which will help offset a large part of the tariff impact on growth. There is worst case scenarios where the tariff rate is even higher at 25%, in which case we would have growth slowing to 0.8% for this year. Just finally on the Bank of Korea, our base case has been 3 more rate cuts by the Bank of Korea in May, July, and November. I'll tell you that we feel quite confident of 3 rate cuts. So 75 basis points of more cuts, taking the terminal rate to 2%. But where we're not so confident is the timing. We do think the risk is that we're confident that the Bank of Korea will cut later this month in May, but we think there's a risk that the July cut may be delayed until August, and then the next cut November. And what concerns us a little bit is that one is the fiscal stimulus that the government is going to be doing could be bigger than we think, and that may give room for the Bank of Korea to not rush with the July cut, delaying it to August. But also we're watching financial stability risks, and we are seeing property prices, Seoul, property prices in the biggest city, Seoul, starting to go up quite noticeably again, which also may get the Bank of Korea to not cut rates as quickly as we think. But so 3 cuts, but the risk is the July cut could be delayed to August. On FX, I think the FX is interesting right now. We think that the Korean won is undervalued on our models. It's about 12% undervalued. It's not the only one. Most Asian currencies are undervalued. You can see the Chinese renminbi, the Taiwan dollar, more undervalued. I haven't got it here, but the yen is even more undervalued than these here. I do feel, I talked about the dollar and how we do think it's going to soften further as US economic exceptionalism fades. We do think at Nomura there is the risk that with the US not being as maybe successful as it wants to be with tariffs, it has climbed down a long way with China because we think the tariffs are having a stagflationary effect on the US economy. And so Trump is pivoting a little bit and not going to be as aggressive on tariffs maybe. But the risk here is that he may be more aggressive in pressuring other current countries to appreciate their currencies to weaken the dollar. That's another way the US could reduce its trade deficit. And there's been a lot of market chatter about the trade deals America's having with Asian countries, Taiwan, Korea, Japan, on whether there is a FX element to that. We don't know for sure, but we do think it's a risk that the US is going to pressure Asian countries that have large current account surpluses, large trade surpluses with the US, to not intervene as much and let their currencies appreciate. And we would put Korea in that camp. And you can see our target in the near term is 1360 and 1330 against the dollar by the end of the year. And finally, you can see here our overall forecast. And I would say that generally we have the dollar weakening further. And you can see against the yen and against the euro. And I'd say the risk around these forecasts is the dollar could weaken even more significantly than we are currently forecasting. Yeah, that's really it. I put here on the last slide our growth outlook and forecast for Korea's economy in particular for your interest. But generally, I would summarize Dr. Jun by saying we have a fairly cautious outlook on global growth. We think the Fed is going to be slow to cut rates. We think other central banks will be cutting rates more quickly and more aggressively than the Fed this year, including the Bank of Korea with 3 more cuts. And we think that the dollar is going to weaken against most of the other currencies, including the won. Let me stop there and happy to take a few questions.
Okay. Thank you very much, Rob, for your brilliant presentation. Very comprehensive, very well thought through. I appreciate that very much. Just to sum up the key points, especially regarding Korea, certainly Nomura, you, Rob, think that the situation, the rather weak macroeconomic situation we face in Korea calls for stronger, more aggressive fiscal expansion as well as monetary easing. We take note of that. And also your description of the global sort of a picture with sort of new normal situations for US, Europe, and Japan, especially in the aftermath of Trump tariff shock. So that was also a good way of putting the whole thing together. Appreciate that very much. Now, because we have only 5 minutes or so, I just ask you a couple of perhaps a relatively minor question here, because the one area that wasn't really covered because it doesn't really deserve that much attention. Nevertheless, there is some noticeable movement in the crypto sector. Bitcoin just set new record of its price, along with U.S. position now is more accommodative to more actively introducing stable coins and other forms of blockchain linked coins. Perhaps they may push for CBDC as well. So your brief sort of perspective on what we are expecting for the near future development of this crypto market, reflecting on what's really happening these days on the ground.
Yes, thanks, Dr. Jun, for the question. I would preface it at the beginning to say I'm no crypto expert. So this is coming from a macroeconomist perspective. I think what has happened, and we're seeing Bitcoin is back above $100,000 now. I think one thing that's happened is I talked about US economic exceptionalism starting to wane. And I think in tandem with that, there is I said the risk is highest that it's been for many, many decades that the dollar as a safe haven currency could be under some threat. The issue is there's not many alternatives at this stage. There's issues with the euro, there's issues with the renminbi, the yen. And so we've seen other alternatives like gold and crypto actually, I think, fill the void to an extent and have much bigger rallies than we thought. The way I would answer your question is I think crypto is becoming a bit of a mainstream asset now because of no real alternatives to the dollar. We're in that transition period where if, and I'm not saying this is going to happen, but if the US economy continues to lose this safe haven status, to fill that vacuum, maybe some of these alternatives are going to be where there is a scarcity issue like gold and Bitcoin could take on more of a role and stronger demand. So, I guess what I'm saying is that there could still be more significant more upside to Bitcoin and gold if the US economic exceptionalism continues to fade quite rapidly.
Yeah, I think it's a good point. Because I think it has to do, at least to a certain extent, that dollar is weakening, but it's no really good substitute for that. So perhaps a quasi substitute is a.
That's a good word. Yeah, quasi.
Okay, this may bring more attention from investors. Now we're receiving lots of questions from through chatting room, but given the time constraint, perhaps one or two your quick response would be appreciated. Sure. One question has to do with this. You are anticipating strengthening of Asian currencies vis-a-vis US dollar. That's it. Within that context, would you expect also Asian equity markets shows strength compared to US market in the foreseeable future?
I'd say the short answer to that is yes. We're overweight India. We recently went overweight China. I would preface it though by saying that I would focus more on domestic related stocks, stocks that are companies that are focused more on domestic demand, because we are going to be getting, as I said, and Korea is a good example, more monetary and fiscal stimulus, whereas exports are facing the higher tariffs and weaker foreign demand. And so I think it will be more of a rotation, and it will be more domestic plays that do well.
Okay, thanks. One last question that I have actually is, this has to do with the another mega, not MAGA, you mentioned MEGA, certainly make Europe great again. That has been pretty much facilitated, that sort of trend, reversal of a previous trend, was by the German decision to relax its fiscal stance, right?
Yes.
Now, of course, they have maintained for a long time this very strict conservative fiscal position. Now they would like to be more accommodative to boost the market and strengthen defense industry and so forth. So that gave some impetus, momentum for this. Now, certainly there should be a limit, right? Because relaxation of fiscal, position, it cannot be good for good, right? There's certain limit. Now, this may apply to Korea as well, because even though you anticipated and you called for stronger fiscal stimulus, but also we have to be mindful at the same time about maintaining or improving fiscal soundness on our part. What sort of this is a delicate question. What sort of balance should we try to strike in the case of a country like Korea?
I think it's a very good question because around the world, I think there's been a relaxation of fiscal discipline. And I think to be brief, I would say that, at times when there's a negative shocks, and particularly when maybe monetary policy is not meant to be carrying all the weight, maybe because our country has high household debt already or financial stability risks, there is a window for fiscal stimulus, which I think is really needed for Korea right now with the tariff shock as well. But it'd be very important to not extrapolate that, and I would say get into the trap that America is getting in, to where the debt ceiling every year gets, extended and extended. So it would be important to maintain medium-term fiscal discipline, particularly with the demographics in Korea. So short-term stimulus, yes, it's needed, but very important at this time to keep checks and balances and make sure this is not a breakdown in the framework, and it means that governments in the future can just start running bigger and bigger budget deficits, because ultimately interest rates will go up from that, and credit ratings will go down, and it will be bad for the overall economy if fiscal gets out of hand.
Okay, that's an excellent point. Short-term stimulus very much needed at this time, and medium, long-term fiscal soundness is something that we have to stick to. That's another good advice. And also, I think we should not forget about the importance of structural reforms that we have to carry out to also maximize the effect of stimulus package and sustained to lead to sustained growth out of this short-term serious headwinds we face now. Thank you very much, Rob.
The structural reform I think is most important in Korea is getting female labor force participation higher. Japan succeeded in that, and I think Korea could as well.
Okay, excellent, great. Thank you very much.
Thank you very much.
Yeah, next time I will try to arrange something for you so that you can come in person next time around. So I would like to hug you rather than say hi virtually. Okay.
I'd love that.
Okay. Thanks a lot.
And thanks everyone for dialing in. Take care. Bye-bye.
Thank you. Bye now.